What is an inverse head and shoulders pattern? As John Murphy explains, a head and shoulders bottom, also known as an inverse head and shoulders, is a reversal pattern which usually happens at major bottoms. However, please note that the same pattern can act as a continuation pattern, especially in areas where prices have had a good run, and then consolidates rather than reverse. Next, let's look at some important points about the neckline of the pattern. Please pause and take a few seconds to read the slide. Finally, let's look at some good examples of such price action. The first example is taken from the weekly chart of Antero Midstream Corporation, ticker symbol AM. As you can see, this is a textbook example of an inverse head and shoulders pattern. However, a lot of people blindly trade patterns without looking at multiple timeframes to confirm that a reversal is in place. There are several ways to confirm that the pattern is valid and will not fake us out. One way is by looking at where prices are on the daily timeframe. If prices are above a rising 200-day exponential moving average, this is our first signal that, if prices happen to break out, it will actually continue to trend higher. Next, look at the weekly 200 exponential moving average. It does not really matter if prices are below the moving average. What matters to me is that prices are well below it, so that the moving average will not act as resistance. Moving back to our example, the pattern does give us a predicted price target as well. This is taken by the height of the pattern, from the bottom of the head, to the neckline, and adding to the point from which prices break out. As you can see from the charts, prices won't necessarily run towards our price target, but rather there will be several resistance levels that would need to be pierced. Identifying these levels are important, since those levels would be a good point to add into your existing positions. Moving on to our next example, this is what we call a variation of an inverse head and shoulders. Why we call it a variation is because there are multiple shoulders on either side. Regardless of the amount of shoulders or heads, everything is the same as what it was for the normal inverse head and shoulders. What's important to note here is the long-term moving average. As I mentioned before, it is important in my opinion for prices to be above a rising 200-day exponential moving average during the time of the breakout. You can see, however, that Multiplan Corporation is below a declining 150-day exponential moving average, which makes it very risky to trade the pattern. Please keep in mind that these don't just happen in weekly and daily charts. These can appear on the 5 minutes, 30 minutes, and so on. What's important to note is that, the longer the time frame the pattern appears on, the more important it becomes.